Your traditional savings account is quietly losing you money every single year. A high-yield savings account fixes that. Here's how they actually work. In this video, I'll explain what a high-yield savings account actually is, how online banks can pay you 10 to 50 times more than your regular bank, whether they're safe, the real math difference, and 5 things to check before opening one. Let's start with what a high-yield savings account actually is. Often called a HYSA, it's just a regular savings account that pays significantly higher interest. That's it. There's nothing fancy, nothing scammy, nothing complicated. A traditional brick-and-mortar bank might pay you 0.01% APY on your savings. That's 1 penny per year for every $100 saved. A high-yield savings account typically pays 4 to 5% APY. That's $4 to $5 per year for every $100 saved. The difference is significant. Here's a quick definition of APY. It stands for annual percentage yield. It's the actual amount of money you'll earn in 1 year, including the effect of compounding. If a bank advertises 4% APY, your $100 becomes $104 after 1 year, assuming you don't touch it. So why do online banks pay so much more than your bank? 3 reasons. First, they have no physical branches, no tellers. No expensive real estate in city centers. Lower overhead means they can pay you more. Second, they want your money. To stay competitive, online banks need to offer attractive rates. Traditional banks are betting on your laziness. They know most people won't switch. Third, they make money the same way every bank makes money, by lending out your deposits at higher rates than they pay you. The math works for them at 4 or 5% APY. Now the big question, are they safe? Yes. As long as the bank is FDIC insured. Every legitimate online bank in the United States is. The FDIC, or Federal Deposit Insurance Corporation, is a U.S. government agency that insures your deposits up to $250,000 per account per bank. That means if the online bank failed tomorrow, you'd get your money back. Up to that limit, the same guarantee that protects your money at any major brick-and-mortar bank. In the UK, the equivalent is FSCS protection up to £85,000. In Canada, CDIC protection up to $100,000. In Australia, the FCS protection up to $250,000. The rule: before opening any account, verify the deposit insurance status on the bank's website. Should take 10 seconds. Now let me show you the real math difference. Say you have $10,000 sitting in savings. After 5 years, here's what happens. Traditional savings at 0.01%, you earn $5 over 5 years. Total balance, $10,005. High-yield savings at 4.5%, you earn $2,463 over 5 years. Total balance, $12,463. Same money, same 5 years, different account choice, $2,458 difference. That's the cost of staying with the wrong bank. Most people are paying it, most don't realize. Now, who should use an HYSA and who shouldn't? You should use one if you have any short-term savings, emergency fund, down payment fund, travel fund, wedding fund, anything you'll need within the next few years. You shouldn't use one for long-term investing. Stocks and index funds historically return 7 to 10% over decades. HYSAs return 3 to 5%. For money you don't need for 10 plus years, invested money grows faster. Here are 5 things to check before opening any HYSA. Number 1, is it FDIC insured? Check directly on the FDIC website. Every legitimate bank shows up there. Number 2, what's the actual APY, not the promotional rate that lasts 3 months? The standard ongoing rate. Some banks advertise sky-high intro rates that drop dramatically. Number 3, are there any fees? The right answer is no. No monthly maintenance. No minimum balance fee. No transfer fees. Walk away from any account that charges fees on basic savings. Number 4, what's the minimum to open? Most online HYSAs require $0 or $25. If they want $500 or more, look elsewhere. Number 5, how fast can you transfer money in and out? 1 to 3 business days is standard. Anything longer is a red flag. Some banks that consistently rank well include Ally, Marcus by Goldman Sachs, Discover, Capital One, Wealthfront, and SoFi. I'm not recommending any specific one. These are just examples of well-known options that have been around for years. Check current rates before deciding. Here's exactly what to do this week. 1. Pick 2 or 3 online banks. Compare their current APY. 2. Open an account at the one that fits your criteria. The whole process takes about 15 minutes online. 3. Transfer your emergency fund from your old savings account. 4. Set up automatic recurring transfers from your checking account on payday. Quick recap. HYSAs are regular savings accounts that pay much higher interest. They're safe because of FDIC insurance up to $250,000. The math difference is significant, thousands of dollars over 5 years. Best for short-term savings, not best for long-term investing. Always verify FDIC, check for hidden fees, and confirm the ongoing APY, not the promotional rate. If this helped, subscribe for more straightforward money education. Drop a comment with whether you've already made the switch to a high-yield savings account. See you in the next one.